Welcome to the deep dive.
Yeah.
If you've ever tried to wade through a 70-page financial filing or one of those investor presentations packed with footnotes, well, you know how hard it can be to pull out what actually matters.
Yeah, extracting the signal from the noise.
Exactly. And that's what we're here for.
Yeah.
Today, we're doing a deep dive into the Q3 2025 earnings for one of the world's major global travel technology companies. You sent us the raw stuff, the metrics, guidance updates, strategic decks, and our job really is to boil it down for you, give you the core story, the key numbers, what's driving them, and, the big strategic shifts.
And it's quite a story this quarter. It was, well, by pretty much any measure, a really strong performance. They comfortably beat expectations. If you only take away three things, maybe let it be these. One, they smashed through their top and bottom line guidance.
Okay.
Two, they actually raised their full year guidance. That's a pretty powerful signal of confidence, And three, this one I find really interesting strategically. U.S. nights growth hit its highest point in over 3 years. That suggests a real domestic travel rebound kicking in for their platform.
Okay, let's unpack that travel velocity piece, because that U.S. strength, it must be feeding into the global numbers we're seeing. When we look at the core operational metrics, Q3 2025, year over year, the volume is just huge. Room nights booked hit 108 million. That's up, 11% year over year? Solid increase.
Right, 11% volume growth. And that translated pretty smoothly into dollars, too. Gross bookings reached $30.7 billion.
Wow.
Which is up 12% year over year. And then revenue itself pulled in $4.4 billion, a 9% jump. But what's really important here, I think, is the quality of that growth, not just the sheer quantity.
That's a great point. We absolutely have to talk pricing power here. The sources, they show this really notable shift in the average daily rate, the ADR. That's, how much folks are spending per night they book. For a few quarters now, ADR was kind of stuck, wasn't it? Flat or even slightly down.
Exactly. Stagnant.
But this quarter, the sources show ADR actually increased 2% year over year. Now, 2% might not sound earth-shattering.
Right.
But contextually, it's a pretty big deal, because looking back, ADR growth was basically zero flat in Q2 25.
It was even negative 1% back in Q3 of 24.
Exactly. So this turnaround, it suggests they're not just selling more rooms, but maybe higher priced ones, or getting better margins on what they sell.
That's really the heart of it for this section, isn't it? You've got the 11% volume growth, more people booking, combined with 2% rate growth, people spending a bit more. That combination, well, it's exactly what every platform wants, healthy top-line growth. It's coming from both more customers and higher transaction values.
Yeah.
And if you look specifically at lodging gross bookings, those were up 13% year over year. That's really what's underpinning that strong overall bookings figure.
Okay, so that confirms the sort of broad market recovery idea. But if we drill down into the actual business structure, the sources tell, well, a much more nuanced story. It's like a picture of two different engines, running at totally different speeds. We're talking about the difference between their B2C, the consumer-facing side, and their B2B, the partner-focused business.
Oh, absolutely. The B2B segment is clearly the accelerator right now, no question. Its gross bookings hit $9.4 billion. That's up a remarkable 26% year over year. I mean, that's really market-leading stuff.
26%.
Yeah. And that translated into revenue growth of 18%. So B2B revenue came in just shy of $1.4 billion.
And this isn't just like a one-quarter blip, is it? The filings suggest this engine's been building steam.
That's right. Their year-to-date B2B bookings, as of the end of October, were already over $3 billion. And they specifically highlight gaining a record number of active partners. It's sustained momentum.
Okay, so with B2B growing at 26% and B2C only up 7%, you have to ask, right? Is this huge difference a sign of maybe a problem in the consumer market? Or is it like a deliberate strategic choice to shift focus?
It seems to be largely the latter, and this, I think, is where the strategy piece really clicks into place. Remember, the company spent years, and frankly billions, unifying their underlying platform technology, all that back-end work.
Right, the big integration effort.
Exactly, and this B2B surge, that's kind of the payoff. They're leveraging that unified platform now to, and I think this is their phrase, fuel a wide range of travel and non-travel companies. So these other companies are essentially plugging into the core tech. What's really fascinating is how this B2B growth fundamentally de-risks their reliance on, super expensive search advertising to get consumers.
Okay. Less dependency on Google clicks.
Precisely. That's a structural advantage compared to competitors who are still in that constant bidding war for every single consumer click.
That context is crucial. And speaking of marketing costs, let's circle back to the B2C segment. So B2B is the growth story, but B2C, you said, remains the margin driver.
Yes, absolutely. B2C gross bookings were up a more modest 7% year over year, and revenue up 4%. Okay, slower growth, but the profitability, it's stellar. B2C posted an adjusted EBITDA margin of 40.7%.
Wow, over 40%.
Yeah. It means their main consumer channel is just an incredibly efficient cash-generating machine, even if it's not growing as fast right now.
Okay.
And, hey, let's not forget trivago and all this, the meta search part. It's often been seen as, well, a bit of a drag on results.
Right, it struggled for a while.
It did. But it looks like their strategic focus, maybe on rebuilding the brand, focusing on transparency, it seems to be paying off. Trivago's third-party revenue was $137 million, up a huge 34% year over year.
34%, that is a turnaround.
And that drove a 22% increase in its own adjusted EBITDA, so Trivago's contributing positively again.
Yeah, if you look closer at why trivago might be succeeding, it seems maybe that focus on clearer pricing, less cluttered results. Maybe that's resonating. Users might just be tired of hidden fees and complexity elsewhere.
Could be. It's certainly a nice little turnaround story tucked inside the bigger picture.
Definitely. Okay, so let's pivot now to the how. How do they actually manage these strong numbers, especially that amazing B2C margin, while keeping costs down? This is where those strategic pillars like platform unification and AI really come into focus, right?
Exactly. Think of the platform integration like moving from having multiple separate, maybe inefficient warehouses to one giant automated central one.
Okay, good analogy.
The B2B segment is like the big high-volume client using that super efficient new warehouse. But the B2C side, the regular consumer business, benefits from that efficiency too. And you see that efficiency reflected in how they're handling customer loyalty. The One Key program, their unified loyalty scheme. It was expanded to 11 new markets globally. Now, this is really critical because it finally lets customers earn points on, say, Expedia and redeem them on Hotels.com or Vivo and vice versa.
Ah, the cross-brand benefit.
Yeah.
Finally connected.
Right. It encourages customers to just stay within their ecosystem, boosts lifetime value, hopefully without needing to spend tons more on marketing to keep them.
And the supply side of that ecosystem, the number of properties available, that's growing too.
Massively. The company apparently achieved 3 times the number of participating properties compared to last year. That's just huge scale.
Wow.
And even within Vrbo, the alternative accommodations, they're adding things like member deals, flexible save your way options, clearly trying to appeal to maybe more value-conscious travelers, keep the volume flowing.
Makes sense. And technology seems to be the real engine behind the efficiency gains. The sources mention AI quite a bit.
They do. And in 2 distinct ways, it seems. First, there's the consumer-facing stuff. They talk about adopting a generative AI search experience.
Like using ChatGPT-style searching.
Exactly. They explicitly mention integrations, so you could potentially do complex searches like Expedia, find me hotels near Central Park with great reviews and a pool. That kind of natural language search, it's a big potential upgrade for user experience.
Yeah, definitely.
But maybe the real margin impact comes from the operational AI, the stuff happening behind the scenes. AI seems to be enhancing 2 key internal areas that really drive down costs. First, developer productivity, basically helping their tech teams build and iterate faster.
Okay.
And second, increasing the resolution speed on servicing. So using AI tools to help customer support handle issues more quickly and efficiently, that reduces headcount needs, operational costs over time.
And that focus on cost discipline, you can actually see it in the numbers, can't
You absolutely can. Direct marketing costs, remarkably, actually decreased 3% year over year.
Despite growing room nights by 11%.
Well, exactly. They're essentially getting more customers for less money. That shows fantastic ROI on their existing marketing spend. Real leverage.
And it's this operational discipline, this leverage, that pushed overall profitability up.
That's the story. Adjusted EBITDA margins overall were up 208 basis points year over year.
Okay, 208 basis points. For listeners, just think of that as roughly 2 percentage points.
Right, just over 2 percentage points better margin overall year on year. That is pure operational leverage paying off. So just to kind of synthesize the financial health picture, the overall adjusted EBITDA margin hit 32.9% for the quarter. That's up nicely from 30.8% in Q3 last year. This margin expansion is really key to their story for investors.
32.9%. Strong.
Yeah. And on top of that, their cash position looks rock solid, gives them a lot of flexibility. Their trailing 12-month free cash flow is nearly $3.0 billion, and they're sitting on $6.2 billion in cash and short-term investments.
Okay, so plenty of dry powder.
Plenty. And that financial strength lets them actively return capital to shareholders, which they've been doing.
Right, the dividend and buybacks.
Exactly. The company declared a quarterly cash dividend, $0.40 per share, payable in December 2025. And they've been active on the buyback front, too. Repurchased 7.9 million shares so far this year under their 2023 program. That cost them about $1.4 billion.
Okay, now we can't really talk about a global giant like this without touching on, well, risk. Specifically, the legal and tax environment seems pretty complex for these big platforms.
Oh, it always is, especially operating across so many different countries and tax rules. The sources do highlight significant ongoing transactional tax exposures. It's just a reality for any platform dealing with global commerce at this scale.
Anything specific mentioned this quarter?
Yes, specifically in Q3 2025, they recorded a $90 million reserve. This was for a potential settlement regarding an Italian withholding tax issue covering the tax years 2017 through 2023.
9 million. Okay.
And separate from that, they also paid $33 million related to Italian VAT, that's value-added tax, for 2023 and 2024. These aren't just, line items on a report. They really underline that constant complex risk of cross-border compliance. It's part of the cost of doing business globally at this level.
Absolutely. A necessary reality check.
Yeah.
So, okay, zooming back out then for sort of a final thought, the core takeaway for you, the listener, seems to be this. This quarter's strength, it wasn't really defined by some explosive B2C recovery, although, the U.S. numbers do look better.
Yeah.
It was much more about two things working together. First, that diversified, really high-growth B2B scaling, which structurally cuts their need for expensive consumer marketing. And second, really disciplined operational efficiency, powered by that unified platform and pretty aggressive AI adoption.
Yeah, that sums it up well. But it does raise, I think, a really important question looking ahead. As the whole travel industry shifts more towards these big platforms and as personalized AI tools just become table stakes, standard offerings, how does a company like this maintain that kind of margin expansion?
Good question.
Will that B2B engine be enough on its own? Or will the inevitable intense competition in B2C, pressure from search engines, other AI platforms popping up, will that eventually start to erode those profits they've worked so hard to build? What are the critical knowledge gaps we need to fill next, maybe around future regulations? Or how AI deployment really plays out long term?
That really is the ultimate strategic puzzle for the next year or so, isn't it? Well, thank you for diving deep with us on all this material today.